trade, global and China framework.
Ladies and gentlemen and friends, it's genuinely a great honor to share the stage with so many distinguished speakers. I wish the event a successful one, and I hope all the friends here can enjoy insightful discussions and forge deep partnerships. Today, the topic is the Chinese economy. We want to understand the long-term and short-term challenges and the opportunities for the economy and the implications for the PMG market, PGM market. But to understand all these questions, it's better to start with the global backdrop. So the global backdrop, a lot of previous speakers have already alluded to it. What I see the best, as far as I can see, the best summary was by Prime Minister, Canadian Prime Minister Mark Carney, who said in the Davos earlier this year, the world is not in a transition, but in a rupture. When he talked about this, he was talking about a geopolitical context, but that observation is still relevant for the global market and the global economy. So we can see several major forces are reshaping the global market landscape. The first is AI. AI is rapidly sweeping across the world, challenging old industrial structures and creating new ones. And secondly, there's the rise of strategic protectionism. We see tariffs, we heard tariffs several times already, and this chart shows the average US tariffs currently at around 12–13%. That's the highest in 100 years. So those are not blips, those are mega trends that are going to affect the growth and market today and beyond in the decades to come. So with that big picture in mind, we can come back to what the implication is for now. So we want to look at the projection for this year for the global market. Broadly, the global market has shown resilience. Despite the war in the Middle East, the market and the global economy has been more or less powering on. The AI investment and the record high equity prices valuation have been supporting investment, powering global growth. The Middle East, the tentative ceasefire reached by the US and Iran have brought the oil prices back to earth. But the uncertainty of this tentative ceasefire could dictate the growth and market trajectories going forward. In a baseline scenario, where oil prices are anchored at around 80%, will project the global growth to be 3.3% for 2026. That's the slowest since 2020, and we see inflation to be at 3%. And that is anchored, as I mentioned, on the assumption that the ceasefire can hold. But if going forward, somehow the Middle East tensions go up again, then growth could be lower to fall below 3% and inflation to be higher. Given the big uncertainties, the global central banks have been very cautious in moving to a more supportive stance for growth. Now, the US economy, the largest economy in the world, still defines the key parameters for the global economy and the Chinese economy. And what we see so far, the US growth has been broadly holding up. Investment, US investment fueled by AI infrastructure build-out and a defense spending boom should keep the US growth to be above trend at 2.2% for this year, and it could accelerate even further to over 2.5%. And on the inflation front, we think the energy shock impact associated with the Middle East conflict has peaked in May, and we see the inflation could fall back to 3.8% towards the end of the year and to 2% range next year on softer consumer growth. Now, another key indicator to inform the Fed monetary policy is the labor market development. We got the latest June reports for the labor market, and it's showing some softening, and the previous month's payroll data were revised downwards. But if we look at the underlying trend of job creation, the job market is still staying strong. So if we combine the indicators from the CPI and the labor market, so CPI is remaining largely subdued, and the labor market is largely stable. We think for this month's Fed meeting, the monetary policy will stay on hold. Since Chairman Walsh took office, the market has priced in a very hawkish Fed stance. But in our view, the federal monetary policy can be more balanced. As I mentioned, inflation pressures are largely subdued, while the labor market has been holding stable. So in this case, we think it's broadly going to be relatively sort of more balanced approach for the US labor market. Okay, if we could move on to China, we need to move beyond the headline figures. China is facing a very deeply divided two-speed economy. The rigid domestic economy is sitting along with very robust exports, while at the same time, the AI-related sectors are expanding rapidly when the domestic economy outside AI are struggling. So this one we indicated exports, despite very high tariffs, China's facing tariffs 10 percentage points higher than the rest of the world, but exports have remained very strong. Similarly, for China's production side. Yet, China's retail sales, which is an indicator for consumption, has been staying very weak. We saw in May, there's a contraction in retail sales, but that's not a short-term soft patch. If you look at the trend, consumption is well below the pre-pandemic trend, and that has stayed the case even after the government pivoted to a pro-growth stance in late 2024. So what's causing this? What's causing this is that the new economy, while it's powering GDP growth, it's not creating enough jobs. To get some perspective, if you look at the data for 2020 to 2024, the new economies created around 1.3 million jobs, was the old economy. The manufacturing, the construction, and finance sectors lost over 8 million jobs. And those have been absorbed by the informal sector, but the informal sector jobs tend to be insecure. So that's not hiding the weakness in the labor market, and that's holding down people's confidence and holding back the spending. The government is likely to use fiscal policy and monetary policy to support the growth, and we see the economy is, the fiscal spending is plan is fairly expansionary, whilst the monetary policy, we do anticipate further rate cuts in the rest of the year. So those are the short-term challenges, but to see where China is heading, we need to look into China's long-term blueprint, which is the new 5-year plan. The new 5-year plan, unveiled in March, has covered every aspect of the economy, but the focus is really on tech innovation and promotion of consumption. In terms of tech innovation, China is really doubling down. It's not just a general mandate, but it's a very targeted approach to advance China's tech self-reliance and resilience. In terms of consumption, the government aims to enhance services of consumption, including healthcare, digital services, and tourism, and so on. At the same time, the government aims to provide stable jobs and boost income. And investment still remains important, but where the investment goes tends to be new infrastructure, which is the physical and digital foundation for the tech transition. So China has shown its ability to combine strategic intent and execution capacity. We do see over the past 2 decades, China has made great progress in transforming the economy. At the height of the property boom, the real estate sector accounts for 1/4 of the economy, but now it has dropped down to below 20%. And now, in 2026, we project it's going to be the first year high-tech sector will overtake the real estate as a prime contributor of GDP. So now, as we come to the end of the discussion, I want you to take home the following key messages, as it were. The world is in a rupture. In the short term, macro rhythm of the market and the growth are impacted by the Fed's policy stance, and the Middle East war or conflict still remains a tail risk to impact on global inflation. China domestically is grappling with this 2-speed economy. The monetary policy and fiscal policy is likely to support and smooth out short-term volatility. And over the longer term, the government is determined to make the transition from the property market and replace it with a robust, high-tech industrial core. So finally, what does this mean for the precious metal market? I think potentially it means a split into two tracks of this market. First, you have the defensive track, which to some extent refers to gold, predominantly gold, to a less extent the silver and other precious metals. So these metals act as the ultimate wealth hedge and geopolitical hedge when paper assets are under pressure. And secondly, which is the defensive track, this refers to the industrial metal property of many precious metals. Earlier we talked about China is shifting from the real property to high-tech driven growth. Therefore, China's demand is shifting away from steel and cement to AI, hardware, and so on. And under the circumstances, precious metals should benefit from this transition. So finally, it is to have success in the PGM market, the investors need to combine the short-term and long-term horizons. Long-term horizons where there's very intense AI-related hardware shortage and surging demand from emerging market central banks. And in the short term, you have the volatility associated with Fed rate monetary policy direction. So it's a very challenging landscape, and I wish everybody success in the market. Thank you.